Nobody's probably ever told you this, but you can actually get paid a premium up front for stocks you already want to buy. Let me show you what I'm talking about. For this educational example, we're just going to assume you want to buy 100 shares of SoFi. Most retail investors, aka dumb money they call us, will just go out there and buy it for the current market value. But there's a better way. Let me show you. I'm just gonna go to the trade options section. Bear with me. I know when you hear options, you hear a ton of lost money. I've lost a lot of money with options, but this is different. So I'm gonna go a month out on my expiration date, and then I'm selecting sell a put. So listen, this is all this means. It's saying, hey, on August 8th, if SoFi is trading at a price that I choose, I'm gonna have to buy 100 shares of it. So for example, SoFi's trading at the time of recording this for $18.52. Now I can select, obviously, strike prices under $18.52, right? At the end of the day, it's the price that you'd actually want to own it. So for this educational example, I'm just going to click 17. Now, when I click into this option, I always like to just look at the delta here. And this is basically a rough probability. It's not the technical definition, but it's the simple definition for option sellers. So it being a 0.29, let's just say 0.30, there's a 30% chance that on the 8th, SoFi will be trading for $17 and you will have to buy 100 shares. But there's a 70% chance, right, that your contract would expire worthless, meaning you won't have to buy your 100 shares and you simply walk away with the premium. Now, what is that premium? Well, if we did one contract, remember, one contract equals 100 shares, we'd collect $81 at the time of me recording this. Now, please understand, these premiums are constantly changing. When I shot this video, this is what I saw. Your results will 100% vary. And yes, with very liquid stocks that have a ton of open interest like SoFi, you can buy as many contracts as your bankroll allows. Listen, at the end of the day, selling options, right, it requires capital, right? And the more money you have, the more premiums you can collect. But understand this, right? Your capital, right? If you did one contract here, you would have to lock up $1,700 until the expiration date. Why? Well, your brokerage ain't just gonna say you can buy 100 shares of something and then you don't have the money to back it up. But let's talk about the risks, because they are important to understand before you get yourself involved in something like this. First and foremost, right? Let's say the 8th rolls around, you open up your Robinhood app, right? And SoFi is trading, sideways. It's still around $18. If that happened, your contract would expire worthless, right? Meaning your collateral, your $1,700 would be returned back to you, right? And you already collected that premium upfront, and the contract wouldn't be in your account anymore. You can go run the play again on another opportunity. The second thing that can happen, and this is the biggest risk, is let's say SoFi drops to like $15, $10, $5. You're on the hook to buy as many shares as you said you would at $17. If you want to learn more about this strategy, there's